Hey everyone, I'm Josh from Investing.com, and this is Investing 101, a new series where we'll be covering common terms and important topics for new investors to help ensure you're doing it the right way. Today, I'm going to be covering the ins and outs of ETFs. You've probably heard this term being thrown around a lot in the world of stocks and investing. If you've been confused by it, or you just need some clarifications, you're in the right place. We all dream of becoming rich like Warren Buffett one day, don't we? The billionaire and Wall Street guru has put his money in the right place over the years, and benefited immensely from it. His holding company, Berkshire Hathaway, has grown at a rate of approximately 20% annually, so it's safe to say that he certainly knows what he's doing. Warren Buffett has historically encouraged all investors to invest in ETFs, and we're going to cover why that is. So here are the facts on ETFs and why you might want to consider investing. So what actually is an ETF? An ETF is essentially a basket of stocks. So you can think of it like shopping at the grocery store. At the store, all your various groceries are put into one shopping cart. Imagine that the ETF is your shopping cart, and the many different groceries are all various stocks. Exchange-traded funds, also known as ETFs, are marketable securities that are based on a specific index, asset, or group of assets. For example, the S&P 500, treasuries, gold, as well as other commodities, or a currency rate. Similar to a stock, the price of an ETF rises and falls throughout a market session, together with the index or assets it represents. The job of the fund manager is to match the performance of the underlying assets by making appropriate investments that track accordingly. Why invest in an ETF? ETFs are special because they offer diversification when compared to buying an individual stock. They provide investors and traders an opportunity to participate in markets that would otherwise be too difficult or costly to piece together on their own. Taking a position in an ETF of the S&P 500, for example, with one transaction, it is much easier and more affordable than buying all the components of the S&P 500, which would need to be properly weighted and ultimately unwound when exiting. ETFs also offer precise control over entry and exit strategies that are not possible with multiple individual stocks or a security with intraday price changes, such as a mutual fund. The list of available ETFs continues to grow as the popularity of the vehicle increases. ETFs have been created to allow investors to participate in new industries and segments, like cryptocurrencies and marijuana, which reduces the risk of investing in these untested areas. Treasury, currency, and commodity ETFs make these asset classes available to a broader pool of investors who would traditionally be less likely to hold these assets. Inverse ETFs are another class of these products, which work in opposition to the asset's movements. In other words, they appreciate if the underlying asset declines in value, for instance, which allows bearish investors a unique opportunity to profit from a market with waning momentum. Alright, so let's get back to Warren Buffett. As a new investor, you might want to get some inspiration from top financial moguls. But what's the best way to do this? Well, with Investing Pro, you can actually see the stocks that Warren Buffett holds in the Berkshire Hathaway portfolio. This is top-tier data, and is an absolute game changer for investors. Since we're covering ETFs, we checked out which ones Warren Buffett has in his portfolio. We did a quick search and found that he holds shares of VOO ETF, or VOO ETF, as well as SPY ETF, which is the oldest US listed and best recognized ETF formed back in 1993. Also known as the SPDR S&P 500, the SPY ETF seeks to track the performance of the S&P 500 by using full replication techniques. For those who don't know, the S&P 500 is made up of the top 500 largest and most stable companies in the US. So essentially, when you invest in SPY, you are investing in a diversified portfolio of stocks containing the strongest companies in the country, from Google to Disney to ExxonMobil. That is why it is considered a stable and trustworthy investment, especially for long-term investors. If we take a look at the history of the S&P 500, we can see that since its inception in 1957, it has earned an average rate of return of about 10% per year. Regardless of geopolitical crisis, inflation, pandemics, and market crashes, it has managed to recover every single time. Warren Buffett has always been a proponent of the S&P 500 low-cost index fund and told investors to keep buying it through thick and thin, and especially through thin. American business is going to do fine over time, so you know the investment universe is going to do very well. He also said,
I don't think most people are in a position to pick single stocks. A few maybe, but on balance, I think people are much better off buying a cross-section of America and just forgetting about it.
In other words, he believes that the best and most stable way to gain exposure to US stock markets is through ETFs like SPY. Advantages of ETFs. An ETF is considered a passive investment because the managers of the funds don't try to beat an index or instrument. Rather, the goal is to match the underlying index or asset. Therefore, an investment in an ETF is an investment in the assets of the fund, more than an investment in the ability of the ETF's manager or management team to make profitable investment decisions. The cost efficiencies of an ETF can be especially attractive to investors because resources are not expended to find new assets, adjust existing positions, or add and reduce holdings. Additionally, exposure to capital gains tax distributions is minimized because ETF assets are not changed as frequently as they are with an actively managed fund. Investing.com analysts recently covered the recent rise of Alphabet stock. For those who don't know, Alphabet Inc. is the parent company of Google. Wall Street was pleased with Alphabet's Q4 and 2021 results released on February 1st, 2022, causing the stock to surge from $2,700 to $3,030.93. That's a 12% increase practically overnight. Alphabet's strong results have also focused on the communications services sector. Therefore, Investing.com analysts introduced 2 exchange-traded funds that could appeal to investors who want to participate in the potential growth in this segment and Alphabet shares. Those ETFs are the Fidelity MSCI Communications Services Index ETF, which invests in the communications services sectors, and iShares Global Com Services ETF, which gives access to global firms in media and social media, entertainment, video, gaming, and telecommunications services. Finding the right ETF on Investing.com. To find extensive coverage of ETFs on Investing.com, hover the mouse over Markets on the far left of the main menu. Choose ETFs. This will take you to our ETF page, which contains a link to a full array of information, including a way to filter by country, issuer, or asset class, performance graphs, and customizable charting on specific ETFs. For even more in-depth analysis on ETFs, you can use Investing Pro's acclaimed stock screener. The screener will help you narrow down your search for new ETFs in seconds. Just insert any parameters you are interested in, such as trading region, stock exchange, market cap sector, and dividend yield, and you'll find exactly what you're looking for. See the link in the description to learn more about how Investing Pro can help you in your ETF investment search. Hey, if you have any questions on what we talked about in this video, leave a comment below and we'll be sure to get back to you. Also, let us know if you have any other investing topics that you want us to cover in this series. See you next time.